Imagine walking into a bank in 2002 with no savings, a terrible credit score, and absolutely zero proof of employment. Instead of showing you the door, the loan officer smiles, shakes your hand, and hands you the keys to a $500,000 home. To understand how that happened, we have to look at the Federal Reserve. Coming out of the dot-com crash and the shock of 9/11, the central bank decided to jumpstart the economy by slashing interest rates to practically zero. Suddenly, borrowing money was cheaper than it had ever been. With money this cheap, lenders got incredibly aggressive. They invented something called the Ninja Loan. It literally stood for no income, no job, no assets. Lenders actively handed out hundreds of thousands of dollars to people who had no realistic way to pay it back. The entire culture cheered this on. Everywhere you looked, on billboards, in TV ads, at seminars, the message was identical. Why rent when you can own? Home ownership was sold as the ultimate path to the American dream and instant wealth. When you combine practically free money with lenders who have zero standards, housing stops being about shelter. It becomes an unregulated cash grab, and millions of everyday people walked right into a financial trap. By 2005, people were buying houses with no intention of living in them. The goal was to buy a property, hold it for a few months, and flip it for double the price. Real estate became a national lottery ticket. To keep the frenzy going, banks threw their traditional rulebooks out the window. Down payments became entirely optional. Risk assessments were ignored. If you had a pulse, you were approved for a mortgage. Everyone, from the part-time barista to the Wall Street executive, was operating on one collective delusion: that housing prices would continue to rise forever, simply because they always had. That delusion is the core of a financial bubble. Millions of people were making massive bets using entirely borrowed cash, completely convinced that the music would never stop. Those highly risky loans, handed out to people with bad credit and unstable incomes, have a specific name: subprime mortgages. Mathematically, they carried a massive probability that the borrower would eventually stop paying. This animation shows how Wall Street handled that risk. Instead of holding on to a bad individual loan, investment banks swept up thousands of these high-risk subprime mortgages and packed tightly together into a single product called a mortgage-backed security. To sell this package to global investors, they needed it to look harmless. So credit ratings agencies reviewed the package and stamped it AAA. In the financial world, that label means it is the safest possible place to put your money. But here is the catch: the ratings agencies were being paid directly by the very same banks who created the bundles. It is like hiring a food critic, then telling them they won't get paid unless they call your raw chicken a Michelin-starred meal. And Wall Street didn't stop there. When they had leftover junk loans that even they couldn't sell, they blended them together into something called a collateralized debt obligation, or CDO. They essentially took the worst of the worst, mixed it up, and got it rated as a safe investment too. None of this was an oversight. It was a massive, deliberate machine designed to launder highly toxic debt into shiny global investments. Soon, the entire global financial system was gorging on these toxic bundles. Retirement funds, foreign banks, and massive hedge funds bought them up, creating a towering, fragile structure of hidden risk. But a handful of skeptics actually bothered to read the fine print. They looked at the underlying data and realized the mortgages inside the bundles were mathematically doomed to fail. This chart shows what those skeptics did next. They asked Wall Street to create a brand new type of insurance called a credit default swap. It allowed them to place a bet that the housing market would drop straight to zero. The major investment banks gladly wrote the insurance policies. They happily collected the monthly premium payments from the skeptics because they believed a nationwide housing crash was an economic impossibility. Think about the terrifying stakes of that moment. The entire world economy had quietly become a massive casino, balancing precariously on the ability of unemployed people to keep paying subprime mortgages. In 2007, the math caught up with the market. The introductory low interest rates on those subprime mortgages expired. Monthly payments spiked, and the housing market finally stopped going up. Immediately, those shiny AAA mortgage bundles imploded. The banks that had stuffed their vaults full of what they thought were safe assets suddenly realized they were holding billions of dollars in radioactive, unsellable garbage. Panic took over Wall Street. Lehman Brothers, a massive 158-year-old bank, collapsed under the weight of its bad bets and vanished overnight. Trust evaporated so quickly that banks simply refused to lend money to each other. When banks stop lending, the global credit market freezes solid. And a frozen credit market hits the real world instantly. Healthy businesses suddenly couldn't get the cash they needed to make payroll. Retirees watched their life savings evaporate in days. By late 2008, the damage was devastating. 8 million jobs were wiped out. Millions of families were pushed out of their homes as foreclosures skyrocketed. Unemployment lines looked like disaster relief camps. The architects of the crash built a financial bomb inside Wall Street's marble towers, but the blast radius wiped out Main Street. Faced with the total collapse of the global economy, the US government decided these banks were too big to fail. They created TARP, a program that handed out a $700 billion taxpayer-funded rescue cushion to the very institutions that lit the fire. At the same time, Federal Reserve Chairman Ben Bernanke took extreme measures. The Fed slashed interest rates back to near zero and began quantitative easing, printing money out of thin air to buy up Wall Street's toxic junk. The rescue worked for the banks. By 2009, Wall Street had recovered, and executives were collecting massive bonuses again. Meanwhile, everyday families were still losing their homes, their jobs, and their dignity. That disparity sparked a wave of public rage. By 2011, thousands of people began to gather in Zuccotti Park for Occupy Wall Street, holding signs declaring, "We are the 99%. It was a visceral reaction to a deeply rigged game. Despite orchestrating a financial collapse that erased $19 trillion in household wealth, 0 major Wall Street CEOs went to jail. They walked away with quiet retirements and multi-million-dollar payouts. The 2008 collapse vaporized trillions of dollars in wealth, but the most lasting damage was the destruction of public trust. A generation grew up watching a system that protects the powerful from their own failures, while leaving ordinary families to sift through the wreckage.